Good morning and welcome to the Killik & Co market updates. It's been a real rollercoaster of a week for UK politics, and we've seen a fair amount of volatility in our currency, with the pound at one point falling to just 1.20 against the dollar. The new bill to ban a no-deal Brexit passed fairly quickly through the House of Lords last night, and it's set to be signed into law today. However, the odds of a general election in the UK this year have been on the rise, and it's now thought there is an 80% chance of a general election taking place this year. So it does seem to be a case of when, not if. Now, at the moment, looking at the polls, it does seem that the Conservatives are ahead and that they would stand to win a general election, but we do know from past experience that polls do not always tend to be that accurate. Now, we have had a small piece of relatively good news from the Bank of England Governor Mark Carney this week. He has said that the impact of a no-deal Brexit, if it were to happen, and it is still possible, he has said that the impact is now looking less severe than it was back in 2017. So back in 2017, some analysis was carried out, and that showed that a no-deal Brexit would wipe off 8% of the UK's gross domestic product. That figure has now dropped to 5.5%, and that's because the preparations for a no-deal Brexit have really stepped up in recent months. So obviously a 5.5% hit to our gross domestic product is not good, but it is looking a lot better than it did 2 years ago. So relatively good news compared to some of the other things we've had to look at this week. Also this week, we've had the first spending review from our new Chancellor Sajid Javid, and he has announced the end of austerity. He's announced a spending increase of £13.8 billion, and supposedly this is the biggest increase in government spending that we've seen for 15 years. Now, there has been concern that this could raise the level of the UK government debt. At the moment, UK government debt is around about the level of £1.8 trillion, and we spend about 4% of our annual gross domestic product just paying the interest on that debt. If you have a look at this chart here, you can see the rise in UK government debt since the year 2000. And where this chart is particularly steep, that illustrates times when government borrowing has been particularly high, and that has really added to the total level of UK government debt. So you can see following the financial crisis from 2008 onwards, there was quite a notable increase in the level of UK government debt. In recent years, the Conservative government has actually been quite good at lowering their budget deficit and actually stopping from adding so much to that UK government debt every year. So in recent years, that curve has really flattened out, and we have seen a smaller level of increase in the UK government debt. So there is a bit of concern that this new spending review will see that curve rise more steeply again. Now, something else the new Chancellor said was that with government bond yields being so low, the government should be taking the opportunity to borrow more money in order to spend on big infrastructure projects. And that's something that was also echoed this week by Christine Lagarde, currently head of the International Monetary Fund and soon to be the new president of the European Central Bank. She has also been encouraging governments around Europe to borrow more money in order to spend on big infrastructure projects. So it is looking more and more likely that over the coming years, we will start to see a rise in the amount that's spent on big infrastructure projects. So do give us a call if you would like to hear more about our thoughts on infrastructure. And finally this week we've had the UK's FTSE 100 quarterly reshuffle. And it's always quite interesting to look at this and see which companies are doing well and have been promoted into the FTSE 100 and which are doing poorly and have been kicked out. So this quarter we've had 3 companies being relegated from the FTSE 100 and 3 being promoted into it. So first, let's have a look at the ones that have been kicked out. The first of these is Marks & Spencer's, and this really is quite a sad moment in time because Marks & Spencer's has been a constituent of the FTSE 100 since the index was first launched all the way back in 1984. So the fact that Marks & Spencer's has been kicked out really shows just how poorly the UK high street has been doing of late. The other companies to be kicked out are technology firm Micro Focus, which has had a string of profit warnings recently, and also the insurer Direct Line. They've seen a fall in their share price since the Financial Conduct Authority announced a review into the practice within the insurance industry of overcharging loyal customers. So that's the 3 companies that have been kicked out. The 3 that have been promoted into the FTSE 100 are Polymetal, which is a producer of precious metals, particularly gold. So Polymetal has done well because the price of of gold has gone up so much recently because investors have been moving into safe havens. The other two companies to be promoted are Hikma Pharmaceuticals, which makes generic pharmaceutical products, and Meggitt, which is a producer of industrial components. Both of those two companies earn quite a large percentage of their revenues in dollars, so they've actually done quite well from the weak pound. So that's the main reason those two have been promoted into the FTSE 100. So that's the main bits of news this week for us in terms of investments. Looking ahead to next week, the corporate calendar is looking fairly quiet. We are looking ahead to results from Ashtead, but mainly next week we will be keeping an eye on the UK political situation. That's it from us. Have a great weekend and we'll see you next Friday.